Hey guys, this is Finance Ease, and you're listening to Finance Ease podcast series. I'm your host Himanshu Jain. In this podcast, we are going to have a real chat with industry experts on investments, markets, and macro analysis. Also, young finance enthusiasts who are bringing change to the industry and how their career unfolded in the world of money management. All are going to be our guests. Stay tuned. In this episode, we are excited to have an esteemed guest whose expertise lies in the subject of wealth management. Now, primarily, wealth management can be briefed as financial planning and managing the wealth of high net worth or ultra high net worth individuals. And our expert has been a professional in the subject for more than 25 years. And his expertise has been an outcome of international as well as domestic exposure. If we take a look back at when he started his career, he graduated from Delhi University in 1995 and for a brief amount of time worked with General Electric and ICICI Capital Services. Afterwards, he went for an MBA to Rotman School of Management, the University of Toronto, which is an esteemed school of business studies, and thereafter worked with multinationals including TD Bank, Citibank, Abu Dhabi Commercial Bank, Standard Chartered, and many more before working in his current role, that is, currently leading the business as partner with SNI Capital Advisors. We shall also encourage while sharing with you the fact that he is a generous and a humble personality who has mentored a diverse set of professionals and has always approached to help his juniors alike in his capacity. We are more than delighted to have Mr. Shammi Khanna as a guest on our podcast today. Hello, Mr. Shammi. Thanks for joining us today.
Thank you, Himanshu, for inviting me for this conversation. It is always great to be among the youngsters and learn from them also because always you can learn from new ideas, the way the industry is changing. So the youngsters always inspires us and they can always give new ideas. So I'm always happy to interact with the youngsters in the same.
Thank you so much, sir. I remember once you told me that learning is kind of a process in which youngsters learn from the seniors and veterans in the industry. And in this process, this occurs vice versa as well. Thanks for that advice. It really worked. Now, how have you been?
I'm good. These are challenging times in terms of what is happening around in terms of economy, in terms of COVID. But yes, overall, we have to keep our spirits high and things are looking good now.
Yes, definitely. We shall remain optimistic and work in our best spirits. Before inviting you, we are really curious about how your career began. Will you please share your journey with us?
Sure. In my show, I did not started my career in finance. My first job, real job in finance, was in ICICI Capital, which was a retail wealth management arm for ICICI Limited at that time, which merged on to become ICICI Bank. It was a unique model. I don't think that model exists even today. Nobody has been able to replicate that model. It was a unique model in that sense that it has a combination of everything. So we had multiple channels of distribution. One was we used to have a sub broker subset for marketing of IPOs and ICICI bonds at that time. We used to deal directly with ultra HNIs for mutual funds, which was the primary vehicle for wealth management, and ICICI bonds. Then we also used to deal with provident funds and other societies and trusts for private placement. It was a multi-pronged approach, multi-channel approach, all rolled into one center, and each center used to have three people. and I used to head one of the centers. This is how I began my career. Back in 1999, if you remember, those were the early days for Indian mutual fund industry and the capital markets. That time, people did not have much knowledge about the financial markets. And if you look at it, they were not even having a difference between, they did not know the difference between mutual funds and equity, or between different types of mutual funds. So at that time, primarily the wealth management was educating the people about different products, how they generate the returns, and what is the likely expectation. Then suddenly in 2001, there was a big issue of. I still remember we had were having a conference on 9/11 that happened. Because of that, everything went down. And just before that, there was anyway the bubble burst of internet bubble burst, so the markets were going down. So for a brief period, the investors' confidence in mutual funds was shaken. At that time, we took upon us to educate it and start marketing more of debt mutual funds rather than equity and liquid mutual funds. Now, liquid mutual funds, as you see today, are very different than what it was there back in early 2000. At that time, most of the banks did not had the option of easy option of converting your cash in your saving accounts into a FD. It was a tedious process. It was not an online process. You had to visit a branch, sign the FD documents, and so on and so forth. And even for withdrawing the money, it was a tedious and long process. So liquid funds was a very easy option, and we educated a lot of corporate treasuries and other people on this, and we had a good amount of conversion. And that saw the in short, I can see that I've seen the evolution of the wealth management industry from the scratch. When it was nothing, when you had to educate, then it became a well known commodity. Today it is just another commodity if you look at it today. Then if I look back to going back to the question of my career, I from ICICI Capital I went on to do my second MBA, which was a specialization in finance from University of Toronto Rotman School of Management. Uh, Post graduation, I worked with the Toronto Dominion Bank in commercial banking as an analyst, as a credit analyst. I worked there for almost a year. Then I switched job back into wealth management because I thought that that is what my passion is. I got a job in Citibank in Abu Dhabi, and then I worked with Abu Dhabi Commercial Bank and Standard Chartered Bank, all in wealth management, private banking sector. If you look at it structurally, the wealth management industry is very different in India than international markets. Dubai is a hotbed of wealth management and private banking. The kind of innovative products that you can look at it over there, and that steep learning that you have over there, it's you cannot describe in words. It's beyond words.
Sorry to interrupt, but
Yeah,
adding
yeah,
to your
please.
point, sir, number of active participants in Indian financial markets is lot less than as compared to other economies in the world, while the financial wealth is less than that of 5% of their total wealth. Again, in contrast to world economies where financial wealth is significant part of their overall wealth. Can India witness such kind of rise and participation in the future?
Uh, Himanshu, it's a good point, but we have to also see that the sheer number of investors and the amount that India has is not less. What we lack is the financial architecture and structural changes that needs to be done before some of the exotic products or some of the innovative products can be brought back to India. I'll give you example. In overseas market, structured notes which are capital protected, not capital guaranteed, capital protected are very popular, and along they are always marketed and offered to the investors along with the leverage, because the cost of funds for the banks over there is very low. So the leverage is offered to the customer at a cost of say LIBOR plus zero point 0.5 for a very good customer, At the most, it is LIBOR plus 200 basis point. Now, LIBOR, as you know, is hovering for the last so many years, not more than 2.5%, and it is even as low as less than 1%. So, effectively, one can borrow money for investing in the financial products from the banks at a cost of say 2.5 3% in dollar terms, while my return is around 6 7%. And on a conservative in the wealth management structure or priority banking structure, it is two times leverage, three times leverage. While in a private banking structure where you are dealing with customers with $1 million plus, the leverage can be 8 times of your principal or 9 times of your principal. So what happens is if our investor invests $1 million, $9 million he get a loan from the bank for investing in the same product. Now that makes $10 million. And if the arbitrage of the return is only even if 200 basis point 2%, so actual dollar term returns for on my principal goes up on a capital protected structure where there is a minimal risk of capital erosion. It goes to 10% plus in dollar terms. Now that is a very good product. Now this product cannot be launched in India because there are the cost of funding in India is very high even today. On a fixed deposit you get 7%. The cost for the bank is 7% is the FD. So at least 1.5 200 2.5% is the operational cost. The bank cost of fund reaches 8% plus. Now in that scenario you cannot offer the leverage. So these products cannot be brought, brought to India yet. Second, we don't have a capital account convertibility. So these offshore jurisdictions, which are Dubai, Singapore, and Luxembourg, what they offer is, capital protected structures, exotic forex structures. There, I can structure it based on the movement of oil. A structure can be drawn. It can be any underlying stocks. So I had, the liberty uh, in banks to drop the structures based on my customer requirement, not what the bank is selling. What used to happen is it is a huge flexibility. So the customer says that I have a view that the oil will go up and gold will go down. Okay, great. What is your expectation in terms of price movement? He gives us his price points. That I combine with my data on my research team and say, okay, so if the movement of oil happens in this scenario and the gold happens in this scenario, along what I will do is I will create a structured note and give it to you, which can give you a return which is anywhere from 7% to 10 12% without taking a risk on your capital. Now this is a beauty of a structured note which we cannot do it in India. Now if you look at the industry in India, wealth management primarily means three products that the people sell. A structure note, which is primarily on Nifties or some other commodities, some of the NBFCs do it. Then mutual funds, which is the primary vehicle for wealth management in India. Standalone stocks and little bit of real estate. In India, we don't even offer the art as a product of wealth management. In overseas market, in offshore market, art, paintings and exotic watches and other things
Structured
also
finance
form.
products.
No, not only structured, they also being offered as a part of the private banking setup. So a private banker is considered someone who is a one-stop solution for a ultra HNI or a family office over there. If he needs financing for his projects or a business, private banker will arrange for it. If he needs wealth management, private banker. If he wants to purchase a yacht, if he wants to purchase a what you say printing, even the private banking setup also offers concierge service. So for my clients I've arranged, I remember one time there was a Formula One racing happened in Dubai when I was working there. So we arranged for our top clients the passes, which was front road passes for that Formula One race. I arranged the passes for my clients for a World Cup final of cricket in London. All these things part of wealth management or private banking, which is not there in India. In India, if you look at wealth management, it primarily means taking money and getting invested in three, four products, three, four asset classes, and that's it. That is what the private banking is. If you look at it structurally, it is very two are very different markets.
So, do you see in India in near future that we can witness such level of banking or services to investors?
Yes, we are slowly moving towards it, but it is still a long way. One is one has to start distinguishing. There are three, four factors that has to happen before the true form of private banking can come to India. One is the structural changes in the wealth management industry. India needs to have a capital account convertibility. Uh, India needs to allow for credit derivatives because then only the good structure notes can be created. The cost of funding has to go down for the banks in line with the international cost of funds. Fourth is regulators have to start treating the wealth management industry from the perspective that they know the best rather than it has to be regulated. Yes, it has to be regulated. Like today, the SEBI regulates the type of fees that a bank can charge in the distribution model from the client. The reality is that they have given the option to the client whether they want to choose a advisory mode or a distribution mode. But practical aspect is that in India, the clients are still reluctant to pay for advisory. They think this is free. Till the time we overcome this and are ready to pay for a good advisor for his advice for investments, the industry will not change. Forget about other aspects of the structural changes that the government has to do. But this aspect is a fundamental change in the mindset of the investors. They have to view that if I'm giving my money to invest, I should pay to someone who generates a good return for me rather than he is trying to take from the back end from the product and generate his income because he will not work for free. A good advisor has to invest in his keep in terms of research and everything. So where does this cost comes in? Ultimately, someone has to bear the cost. An investor has to bear that cost till the time they understand this, accept this, and start paying for the advice. The major changes in wealth management are unlikely to happen. We cannot move to the next level of wealth management.
Now, going back again on when you started as a credit analyst at TD Bank and switched to wealth management. Now, people in finance tend to opt for investment banking, corporate finance, or equity research role because they are held as glamorous role. Now, how is wealth management as a career option? And was wealth management always your calling?
See, one has to understand what is one good at. Yes, investment banking. Today, if you look at it, at my career today in SNI, I'm doing more of investment banking than wealth management. But then wealth management is a very good career if you continue with it. One has to understand what is the passion, what are the strengths and weaknesses of someone. Wealth management is a good job, and one has to also understand and accept that investment banking jobs are very few, while wealth management job are maybe 20 times or 30 times more than investment banking job. In fact, much more. Today, if you look around the financial industry, the majority of the finance jobs, I'm talking about frontline jobs, are into wealth management. Not even 10% are in investment banking or even less. I don't have the figures, but I think it will be even less. Wealth management is a good career option for someone who is passionate about investments, who is passionate about stock market, who is willing to experiment with the the market. For him, wealth management is a good job.
So, in India, does investment banking and wealth management mean the same, or are they completely different but can be expected or required out of you in some cases?
Now, that is a very interesting and good question, Himanshu. In India, they are very, very different. In offshore market, what happens is a private banker, as I was telling earlier, also does a part of investment banking. Within India, also, if you look at it, there are some platforms where they do startup funding, which is part of investment banking, as part of their wealth offering or family office offering. In some institutions, they also do M&A or the promoter funding, which is part of investment banking. It becomes part of wealth management. Now, if you look at this scenario, even in India, the lines at times, depending on the platform, gets blurred. So many things like credit suisse, for example, I give you an example. We do a lot of investment banking uh, products and deals which are part of the private banking. It is housed under private banking. It is not so that in India it is not happening. Avendas is another platform, Client Associates is another platform. So there are platforms which are family offices, what we call in India, setups, which gives the one individual to experiment and make a career which is both into private banking and wealth management. If you look at a typical bank setup, which are the biggest wealth managers in India, they have a very straight line. It is wealth management means wealth management, and they are not uh, products that you can offer directly from other streams.
So, there are divisions along the line, right?
You can. The only thing that you do is introduce someone from the other division to the client, and then it is between the client and that division's person. But in family office setups or the NBFC setups, this line is slowly blurring. It has not reached, we have not graduated to that level what offshore markets have graduated. But definitely, we are graduating towards that level. So, real estate has become an integral part of wealth management today in India. So, the structured notes, some of the NBFCs are they are offering, although they are limited in offering because of the structural nature of financial markets in India. But yes, they are offering. So they have started doing these aspects and these products into wealth management. So if you look at it from the industry point of view, structurally we are moving in that direction. Now coming back to your question about the career, uh, it all depends on the passion and what are the skill set one has. One has to also understand that one should also be cognizant of its strength and weakness. So, if your strength is not the stock market or understanding what kind of investments it is there, and you are not an outgoing person who loves meeting people, then wealth management is not the right choice. You may be passionate about stock market, your passion is there, but your strength is not there. Then you are better off you go and become a research analyst or someone on the back end generating reports, because then that may be your strength. So, depending on the strength as well as the passion, one can take a view what should be the career path within the wealth management.
So, if we look at the competencies required for career in wealth management, the person shall be an extrovert and open to meeting people. Obviously, should be intelligent. Now, if you can summarize the brief points as competencies required for career in wealth management, will you please?
See, one has to understand that in a wealth management setup, There are two different branches within the wealth management, distinct branches one can take it. One is the wealth management, what we talk about privately banking or mass banking, and one is a private banking setup. The difference is that in a priority setting, which is different banks have different names for it, but which is basically offered to the customers which are 20 lakhs funding funds with them and above. While a private banking setup will talk about 2 crores and above. Now, you will not get a job in private banking directly. One has to graduate from the wealth management and then graduate into private banking, because private banker typically has the experience of 10 to 15 years in wealth management before he becomes a private banker. And within the wealth management there are two distinct or three different streams that one can look at it. One is a pure wealth manager, which is more of generating the revenues from the banks, dealing with the clients of the banks directly. For that, you need to be an extrovert person. You should be able to understand the markets. You should be able to understand the psyche of the investors, sentiments of the market, and you should be very convincing in your arguments and persistent in your effort, because persistency is always required. Hard work is required.
So, soft skills play a role in the career and meeting new people. And being comfortable with them is one part of it, right?
Right.
Okay, moving on to our next section, which made us really curious to know that wealth management is considered to be sales oriented to clients. Is it really so?
Yeah, good question, Himanshu. Leaving from where I left in the last question. So in wealth management, there are three different branches. One is a sales oriented, which is wealth managers. There you have to acquire the clients, and you're uh, always required to acquire new clients and service the existing clients. Within that, the next level within the sales is that you become a team leader, regional head, and then zonal head, and ultimately leading to a national manager and a business head. So the moment you move away from above the team leader position, there the skills required for is more of understanding the market, giving the summary to the investors in a different form, and also managing the people. So more than the sales, it is managing the people that becomes a critical skill. There is another branch within the wealth management. After sales for a couple of years, you can go and become investment counselors. Now, every setup does not have, but many setups do have investment counselors. They are primarily like in many setups, what happens is three, four wealth managers, or maybe seven wealth managers in a priority setting has one investment counselor. Investment counselor goes with the salesperson, what you call wealth manager, and helps the sales manager to close the deals. So there the skill set is required is technical knowledge about the industry, how and markets, what are your views. You should have your own views. You should be able to answer Q&As of the customers in for the market and the industry, and that is what the primary job of investment counselor is. The third setup within the sales, it is not that much of sales, but it is private banking that one can join after 10-15 years of experience within the wealth management. So the people who don't like man management job, they opt for private banking. In private banking setup, it is a flat structure. Uh, MD is a person with 20 years plus experience, so very senior person, and he is the team leader in de facto. And then there are private managers and assistant directors or directors, private bankers, directors and assistant directors who are with that kind of experience, who are part of his team. In a private banking setup, the sales is not that important because the number of clients you handle is not more than 20 clients on an average. So that Once you have acquired them, you don't need to acquire, keep on acquiring them. What you need to do now is, instead of acquiring more clients, you have to serve with them a breadth of products that includes some of the investment banking products, some of the trade finance products, and so on and so forth, so that you are able to service the entire needs of that client, and you have to increase the AUM of that client with the bank. That is your primary job. So instead of sales, it becomes relationship management more. So you see how the industry is structured and how you graduate. So if the sales wealth management, you start with a pure sales job. You may not end up the entire career in sales.
So, those are some really interesting insights for our listeners. Now, going forward from here, can you please elaborate us on the challenges in this subject?
See, one of the biggest challenge in the wealth management industry today is coming from the institutions or the market players. There is a lot of focus on many NBFCs in the banks for the revenue. There is a lot of pressure on the wealth managers to generate revenue, because the SEBI in its wisdom has reduced the margins. So the instances of mis-selling, to my mind, has increased. Yes, you are helping the investors, but there is a very thin line. What should be the minimum cost for distribution or taking the product to the investor? Now, you cannot regulate that. You can I think we are reached a stage where we are over regulated. We need to loosen that aspect, leave it to the market forces. Yes, there has to be upper limit. You cannot go back to the old era where you're charging 5% upfront without the customer knowing. But somewhere we have gone to the other extreme, where there is no upfront commission in the mutual funds today. Everything is on a trade. That is very extreme. So we have moved from one extreme to the other extreme within the last 20 years. So we have to find a middle ground, and that will help the industry as well as the uh, people in it.
And if we go a little deeper into the subject, what are the risks involved and how are such risks managed?
That risk has to be managed more at the institution levels. The wealth management outfits have to reduce pressure on the wealth managers to generate revenue. One. Second is, they have to be vigilant in their efforts to monitor the portfolio of their clients. Not today, it is more of a reactive mode they are in. It is not proactive mode. When I say proactive mode, it means that you are monitoring the uh, client level positions on a regular basis. You are equipping the wealth managers with enough knowledge. There is a centralized software which can point out if there is a over concentration of a client in a particular sector or a stock or a asset class, and whether that asset class actually suits, is as per the profile of the investor or not. Now these are the back end uh, initiatives that wealth management has to uh, outfits have to take, built in the systems and processes for monitoring the wealth managers. Second is equipping the wealth managers with knowledge, regular training, and training not just for training's sake. It is more of training them in the skills, in the products, and the knowledge of the market. Today, if I see around, I meet many wealth managers who are not concerned and are not knowing the product deep enough. Very superficial knowledge. It is not their fault. It is a great extent a fault of the institutions they are working with. Yes, but at the same time, the fault also lies with the individuals, because they are looking for quick bucks, quick career. I will sell it at no at any cost. So the wealth management has become more of a sales job rather than managing the investments of the. Now this has a taken change, this change in the last 15 years or so. I remember when I started my career, a wealth manager was seen with lot of respect. There were very few wealth managers, and the people would treat us like someone who has a knowledge, who will sit with us, spend time with us. Okay, even to some extent, this is a fault of the investors who treat wealth managers as no more than a courier boy. And this all the so if you have to manage the risk, it has to come from all the players, all the stakeholders. It cannot be just fault of the institutions all the time. The buck also has to start and end with investors themselves also. Nobody is ready to call and say yes, the investors have to take these responsibilities. Nobody, because they fear that it is a very popular thing to do and it may have a backlash.
Moving on, that educating clients must be a process. Now, what role does educating the clients play? And can dealing with some clients be tricky?
Uh, Imanshu, yes, client education or investor education is very, very important. But the investor education cannot happen overnight and it cannot happen at one form. It has to happen at the institution level. So that means the NBFCs and the banks have to educate the investors. Regulator has to step in and put in some regulatory aspect and educate the customers, but they don't have to frighten the customers today. That will frighten the customer the moment they step in. Third aspect is the mutual fund industry or the people who are managing the actually investing the money. They have to educate the customers. They have to spend more time and energy in educating the customers. Third is there has to be some kind of the neutral parties who have to come in and educate the customers. And investors themselves also have to read. You can't always depend on, if you have to gain knowledge, depend on others to always do your job. You also have to take time out, take pain, and read the documents, read the investment documents, at least understand the investments. Today, if you look at it, most of the investors will say, okay, इसमें return कितना आएगा? Okay, this is the rate of return, great. And what is the track record? Great. Okay, this is a good brand name, rate of return is good, expected rate of return is good. Okay, let me invest. That is not what the true justice. You have to ask the questions.
So, what you are suggesting is that this is not the wholesome approach. Is that what you are saying, right?
Yes, that's true. See, the investors themselves don't want to take the responsibility. Investors also have to take the responsibility of knowing about the products, understanding before the risk. And I give you example. Now, debt mutual funds are sold as FDs, were sold as FDs. Now, people are more aware. It is not an FD. The investor has to understand that the underlying what a debt mutual fund does is invest in different bonds of different companies. So the risk, what is the risk? If one of the underlying companies go bust, like it has happened with ILFS, so your investment can go, you can have a negative returns even in debt funds. The second risk is interest rate risk. If the interest rate goes up, your value goes down. The value of the investment, existing investment goes down. Now, they are not aware of this. They think that that fund is safe. Now, with the Templeton fiasco that happened, people are more aware. Now they're moving to the other. No, that everything in the mutual fund is very risky. We should not invest. That is again an extreme reaction.
There is herd mentality of, I'm getting right?
Exactly. There is a hard mentality. You are not understanding what is the product. So the product within the debt funds, there are a number of permutation and combinations, low duration product, gilt products, corporate commercial paper products. So depending on the scheme, one has to understand these questions. Do they ask the wealth manager these questions? Answer is no. The only question to ask is from which fund house it is, what is the return, whether it is a close ended or not, and what is the commission. That's it. That is what they ask about. Now, is this the fault of the wealth manager or the investor who is not willing to spend time to invest his money and understand where he is investing? If he is investing blindly, then you can't just blame the wealth manager. It is the fault of the investors also.
So, educating clients is a responsibility of both the parties, that is, of the manager as well as the client. But institution does have a role to play too. Is it correct to say so?
Right.
Moving on to a last question, which we tend to ask of a guest on the show, is about technology. Now, what is the future of wealth management and what role will technology play in it?
A very interesting question, intelligent question, I would say. Wealth management industries will undergo a tectonic shift in terms of the structural changes it will see. I will tell you how. Today, I see the startups that are coming within robo advisory is the new kid on the block. Robo advisory will change the structure. So the mass market of wealth management, where today, the RMs of 2 3 year experience or 1 year experience are there, they will be replaced by algorithms. So they are robo advisory firms which are built the robo advisory platforms which will automate the wealth management needs. So it will be in a Q&A form. They will understand what is the requirement of the client and they will give up the model portfolio. Having said that, robo advisory will never be able to take care of HNI, ultra HNI segment. Yes, they will play a big part in technology, will play a big part in terms of, shortlisting the products, the way the products are presented, drill down and the research of the products. There again, the technology is playing a major part. That will happen. But yes, the mass market, which is a major number of clients where the investable surplus is up to few lakhs of rupees, that will undertake a dramatic shift. It will move to robo advisory. Second is, if you look at the new players which are brokerage houses, which are giving the access of online investing in the direct stocks to the common man because it is making them affordable through technology. So that is the second aspect of change. The third is risk management within the large firms of the wealth management. That is moving to the automatic form and technology is playing a major part in it. Earlier, if I remember that when I started my career, for a mutual fund, because I'm talking more about the mutual fund because that is the primary product in India for wealth management. There used to be fact sheets which they used to print and send it to us, and we will used to take it to the clients like a brochure. It was very colorful, printed, and very good brochure, glossy papers, and everything. Today, the fact sheets are available online. Now there are different softwares available to the investors if they want. They can subscribe to, and when they put in different products, they can see what is the asset allocation to different stocks, different sectors, or different asset classes. Now that is technology. You can say software is technology. Then there are firms which have developed proprietary software which gives the model portfolio and the drill down of the portfolio of existing portfolio. Their softwares are coming in. Some of the companies are providing that service where even the tax is calculated automatically on the investments. And if you're doing trading, that is also calculated automatically. So taxation aspect has come into play in the wealth management. So if you look at it, the technology is making it uh, easier for the wealth managers to give a wholesale advice and a portfolio to the clients. Uh, Apps are there today. The new apps are there which are targeted only for systematic investment plans. So one product, one application, but through technology, it is reaching out to the masses in the rural areas, in the tier 2, tier 3 cities where the wealth managers are not there. So that is helping that the rural areas and the tier 3, tier 4 cities to access the wealth management products online through technology platforms.
All right. If I'm following you correctly, to summarize, there will be an integration between technology and human approach, such that mass affluent investors will tend to follow robo advisory mode, while high net worth or ultra high net worth individuals will be served more customized approach. Right?
Right.
Well, sir, it was a privilege having you on the show, and you really made this episode rich with your expertise and knowledge. We really had insights, and we appreciate that. Thank you so much, sir.
Thank you, Himanshu, for inviting me and sharing my views with the young audience. It is always a privilege to be on such platforms and sharing your views. Thank you, Himanshu, and best of luck for your future endeavors.
Thank you again, sir. Thank you so much. And that's a wrap up from our today's episode. Thanks for listening to Finance Ease podcast. If you like the podcast, do give us a review on Apple iTunes. You can also share it with fellow listeners and do follow us for more. Stay tuned.